They bought the dip, then they let it go for a few days, really.
If that was a dip, right?
If that was a dip. Define a dip here. What kind of dip would you buy?
I mean, 1% sell-off isn't really a dip worth buying. I would say 5% is a dip, 10% is a correction, 20% is a bear market. That's kind of the way we, talk about it. So we do think a 5% correction or dip is possible based on the move in rates. That's kind of been our view. And quite frankly, we're still stuck in that range that we identified earlier this year, 5,500 to 6,100. So we got closer to the upper end of the range. Now we're going to get a dip. I'd be surprised if we take out the 5,500 unless something really, deteriorates again on the tariff side, okay? And we go through that in our mid-year update. Like, a lot of things now have turned the corner from a rate of change standpoint. That's going to make it hard to return to a sub 5,500 price in our view.
Is the tariff the only left tail risk? Because it seems that a blown out deficit with this new tax, this one big beautiful bill, is concerning markets, at least when you look at rates, right?
Well, that's right. And that's exactly why we can't break through to the upside, because there's two things going on the rate side. Number one, you have excess supply. The deficit now is a problem again, potentially for the bond market, but also the Fed's on hold, right? The Fed has been a bit, overly focused on inflation, and so you don't have any rate cuts in the near term, and you now have this supply risk and the fiscal deficit blowing out. So that took rates back about 4.5%. That's always been our level where multiples come in. That's a 5% move historically. That's not a 10%, 20% move in isolation. Now, if that leads to something else where we have another growth scare, for example, because rates are higher, and all of a sudden recession risk comes back on the table, that's a whole different ball game. That's not our view.
Okay, so for long end rates, at the very least, at what point do they become a bigger problem for the equity market?
Yeah, I think 5% is where it becomes a real headwind for
10-year.
Yeah, for consumer, everything's priced off the 10-year, right? So then all of a sudden you're looking at, oh my goodness, we have now recession risk potentially is back on the table. But in that instance, just think about it, the Fed will act then, right? I mean, so we have this sort of, it's going to be back and forth like this for the next 3 to 6 months. The way you got to think about the first half of the year, most people came in very bullish. We came in more, not that bullish about the first half because of the sequencing of policy. But that policy now has flipped to a more pro-growth sort of stretch. And that's what the market's going to start to think about. That's why it's going to be really hard to take out 5,500.
That is, by the way, my question of the day, Shanali. At what level do yields really start to put pressure on stocks? And you're saying 5%. Goldman Sachs was out this morning saying 5% as well. Chris Waller was speaking, I think he was on Fox this morning. Are you looking at me funny?
Yeah, I forget exactly where he was as well. I just saw the headlines.
Okay, but he was saying, if tariffs stay at 10%, the Fed is good to go in terms of cuts in the second half of this year. What are you expecting from the Fed in terms of stimulus? Because that is important to the stock market at the end of the day.
I think it's critical. It's another factor, though, the rate of change is going to turn more positive. Don't forget that, the big rally last fall was driven by Fed cutting into an economy that was fine. And then they stopped in December. That was really the beginning of the correction that we saw, not tariffs. Okay. So, yeah, I think that the Fed will be either communicating that they're turning more dovish or they'll actually be cutting. Our official House view is no cuts this year. But then they have 7 cuts for next year with no recession.
Yeah.
So that's pretty bullish. So, I mean, if we get 7 cuts with no recession next year, stocks are not going down.